Last year, Barron's put out a list of the best stocks to purchase for 2022, and they significantly outperformed the S&P 500. And this year, for 2023, they released a new list. And so that's what we're going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. I love reviewing lists when publications put them out just to see what sort of names they're covering and they're sort of like recommending to buy. I always like to just like analyze it and see if it makes sense. And so let's dive right into the Barron's list for the best stocks that they recommend to invest in 2023, or at least they say that these stocks will likely outperform. But first, let's start with their track record. So for those of you who want to take a look at the article, this is what the cover looks like. And I love that they have RJ Barrett on the cover. Now, this guy's a guy from Toronto who's, one of the superstars in the NBA. So I just love Canadian representation in the NBA. But here is the list of stocks that were listed for 2022. So notice they had Amazon, AT&T, Berkshire, General Motors, Hertz, IBM, Johnson & Johnson, Nordstrom, Shell, and Visa. And you can see that Amazon underperformed, of course, to this tech name. GM underperformed as well, interestingly enough. Hertz underperformed, but look who outperformed: IBM, AT&T, Berkshire, and Shell. Of course, the oil business definitely outperformed. So on average, they earned a return of a negative 1.7%. Meanwhile, the S&P 500 earned a return of negative 12.1%. And so a diversified basket is a key to winning. And I will say that I do like diversification. Some of you guys who watch these videos don't really like diversification. And, we can agree to disagree there. And note that the people that took the largest losses in 2022 were also the people who are most heavily invested in tech and crypto. And so, that's another example of just because you're a super bull on a particular industry doesn't necessarily mean that you'll be right. And so that's why I always stress diversification on this channel. The underlying assumption with that is, of course, we're not as smart as we think we are. At least I assume that I'm not as smart as I think I am. And I naturally assume that I'm probably missing something in my research or not analyzing or thinking about it correctly. And so I try to aim for a large margin of safety just to make up for my ignorance. And so let's go into the 2023 list that Barron's has recommended. So you can see in their list, I highlighted some names, but overall they got Alcoa, so the aluminum business, Alphabet, Amazon, Bank of America, Berkshire again is making it on the list, Comcast, Delta, Madison Square Garden Sports. So you can actually invest in the New York Knicks if you really wanted to, Medtronic, and Toll Brothers. Now, a couple of points that I wanted to make here. The first one is Alphabet. I'm going to dive deeper into this one in this video. But, Berkshire Hathaway, I think if you're looking to shield your portfolio in a continually declining environment, Berkshire Hathaway is probably that name. I probably think it's like the ultimate defensive stock in this environment now. I will provide you guys with a model for Bank of America, Berkshire, and Comcast. These are not in the tracker yet. And then, I talk at length about home builders, and I'm probably the only one in the value investing community talking about home builders on YouTube. At least that's what I've seen thus far. Now, as much as I like Toll Brothers, and Toll Brothers will be a name that will get added to the model. And the reason why I like Toll Brothers is because generally their home sales are around like $1 million or more. And so they're dealing with a really affluent clientele. And this affluent clientele is generally older. They've built up a lot of equity. And so I think it's like a fifth of the homes that they sell are sold cash only. And so, in an environment where interest rates are rising, Toll Brothers is likely shielded. Now, Toll Brothers has long been a stock that people think that Berkshire Hathaway will inevitably end up buying. And I think that is a likely scenario as well, but it might be too small for Berkshire Hathaway at this point. We'll see how that plays out. But I like the spec builders in the space. And you guys know that I've recommended a couple of spec builders that I'm adding to my portfolio. It's never a recommendation for you guys to buy, but the reason why I like the particular spec builders that I've talked about on this channel, and they're on the tracker, so if you just have access to the tracker, you can just see them, is because one, they have very little debt, and two, they compete in a space that is equivalent to the rent versus buy decision. So for a lot of people, it might just be worth it just to buy a house, a new house, and pay the same amount that you would pay in rent anyways. And of course, the fact that they have zero debt and they've been operating for a long enough time horizon, they will probably have the tools necessary to survive through a downturn in the economy. And so, also there's a valuation thing there as well. Some of these names are very cheap. And so, that's sort of my thoughts on the home builder space. But the home building space is the largest industry that I've invested in my portfolio thus far in 2023, above Alibaba. But now let's dive a little bit further into Alphabet, because this is not a name that generally ends up on lists, because Alphabet is generally very expensive. Like, it's priced really high, or appropriately in my opinion, because it's a phenomenal company. And so let's dive into it. So overall, Alphabet has been under some pressure, and the share price did decline by over 30% in 2022. And so one of the questions you would ask is, why did their share price decline so much in 2022? Well, the answer is, I've highlighted these three segments: search, YouTube, and cloud. And so the three largest segments are under pressure at the moment because they are struggling, or at least searches, which is search and YouTube, which I would consider is the second largest search engine in the world, are struggling with slowing advertising spend. Cloud is also slowing at the moment. And so all of this, in my opinion, are short-term issues, and post-recession, Alphabet, I believe, will remain a highly profitable and important organization to the world and to just global commerce. And so, yeah, things are slowing, but the way to play this, I think, is that in your valuation models, you just forecast out a slowdown and then see what valuation you get and ask yourself, are you getting a large enough margin of safety? And so you guys may not necessarily have your models built out. No problem. I'm going to show you the model that I have built out to forecast out Alphabet that the Patreons get access to at that lower tier. So here's how I'm forecasting Alphabet out. You can see 2021's growth was 43.1%. I'm not going anywhere near that. And you can see these huge growth numbers. I'm not going anywhere near those at all. I've already slowed down Alphabet for many, many months. And so, I wrote it right here. I've long ago slowed down the growth in the segments, and I've warned about this slowing issue for many, many months. And the real slowing issue that I've been talking about is a slowdown in ad spend. In fact, I probably started talking about that, I would say, in Q2 of last year. And so the Patreons have had this model for a long time now, but I just want to point out, so, a 10% growth in Google search, this might actually be zero in 2023 as ad spending comes down. You could absolutely see it not growing, but ad spend will inevitably continue to grow in the digital space, and Google search serves a really good purpose. And especially if we're entering sort of like an inflationary economy, this is a hedge on inflation as well. Because it operates somewhat like an exchange, the spend will just continue to go up. Now, you guys may disagree with me on that point, and it would be fair if you did, but the point I'm making is that I think the Google search product is remaining important, and I think it can grow at a rate of 10% for the next 5 years. But, this might be a little bit optimistic, but, it's still showing signs of huge growth. I just am not willing to forecast it at 40% as you saw the growth in 2021. Now, for YouTube ads, I'm actually forecasting 0% growth in 2022, which is a large diversion from the rate at which YouTube is growing. And really what this reflects is sort of like the backwards nature in YouTube ad spending in at least the latest quarter. So they just had a bad quarter. And I think overall 2022 will end at around 0%. And then I'm just growing it at 10% in 2023 and then 15% and beyond. Now, YouTube remains a phenomenal place to advertise. I think they are doing well with their reel, or the shorts at least. It's Meta that owns the reels. I think YouTube is doing well with the shorts. I think long form content, it's the only place to go. And so you have a huge moat here. So you got a huge moat in search, you got a huge moat in ads. And then, of course, the third place cloud provider in the industry behind AWS and Azure, which is owned by Microsoft. This thing has been growing substantially fast. Now, because it's so small, it's got, a lower base to grow off of. So I am going to grow them at 20% in 2023. This could come down, but I just think it's probably going to grow. And, they're expanding the number of products that you can utilize as well. So I just think you're going to have stickiness in the customers and the number and an increase in the number of products that they're going to utilize. So 20% I think is reasonable. And then I'm slowing it down to 15% thereafter. I think this is a little bit pessimistic, but just note that overall the cloud industry is expected to grow at around 15%. So that's why I brought this down to 15%. And so you notice how revenues are just growing in the low double digits. So this is as pessimistic as I think you can be on Alphabet while remaining somewhat realistic. And so now that we've sort of built out those granular segment level forecasts, how does this look in terms of the valuation for the company as a whole? Well, you can see that using a terminal multiple, which is 5 years out at 17.5 times earnings, notice that I'm valuing the company at approximately $130 per share. So that's not a bad valuation. Now, my valuation has come down a little bit as I've brought the growth rate on some of the segments down, which is fine. And so, relative to the current share price, it's trading at 2/3 of its valuation. Now, for a lot of people, this is enough of a margin of safety, especially for a company as fantastic as Alphabet. And I wouldn't fault you for saying, hey, look, now's the time to buy the securities. And you're probably right. And, the last time they did go under $100 per share, they did surge back up. And so this probably is a good price. However, I'm being very picky in this environment. I'm just sort of like, come to me as the stock market continues to decline. And so I really want to see this under 60%. If I can get it in that 50 area, maybe I'll think about it. I don't know, but it is a company that I do want to add to my portfolio. But once again, guys, you guys know I'm getting very, very selective in this environment. But, the other thing that I'm pointing out is that as the cash position in the portfolio continues to grow just from new fresh cash coming in from either work or the businesses or whatever, I need to start deploying the cash. Now, it never really burns a hole in my pocket, but, enough is enough sometimes. Scared money doesn't make money. And so, we'll see how this sort of plays out. But the one area that I do like to look at when the stock prices aren't really in the realm that I would like to see them is I like to look at the cash secured puts to see if I can at least generate money on an exercise price that I would take to purchase the stocks anyways. Now, some of you guys might be new to cash secured puts. And, if you're not comfortable with it, I always say the best thing to ever do is just buy the security and hold it. Never go into the option space. It's just for psychos like myself and, more advanced investors. But I did create a free to use and download cash secured put analysis tool. And the reason why I'm giving it to you guys for free is because, once again, the point of this channel isn't necessarily to make a ton of money. The point is to help investors. And so let's take a look at that cash secured put tool as it relates to Google or Alphabet. And just a quick note before we get into that, I know I showed you guys that Alphabet model. If you want access to it, you can get access to it at that lower tier. Now, the other thing that I always say is if you join the Patreon and you take a look at all the models and you decide that it's not for you, just email me, let me know that you didn't find value in it, and I'll refund your $5 completely, no questions asked. I've done that for a few people in the last couple of months. And so no questions asked, take a look at it. If you don't like it, it didn't cost you anything. I don't want to take your money if you're not getting huge value out of it. And so moving on into the analysis of the options. So you can see the stocks is down almost 40% over the last year, right? And so, the first question I would ask is, will the share price decline continue into 2023? I think it could very well continue. Advertising spending is very cyclical. And, if we see advertising spending continue to fall off like we did in 2022, then you could absolutely see that the share price will come off further. And so, then here comes the question of what are the CSPs saying if, I'm valuing this at 130 and it's not at that $60 area that I'd like to, that I would throw money at to buy the security. Well, let's take a look. So here are the cash secured puts for January 19, 2024. So this is essentially 1 year out. Here's a $65 exercise price. This would be, exactly 50% of where I'm valuing it. And you can see you can get these anywhere in between, or you can sell these at anywhere between $2.30 and $3.70 or whatever. So I'm just going to go with $3.50, but who knows if you can actually get that. But you can see here's the cash secured put tool that you guys have access to. And so when you look at it, you'll already see me have these inputs in there. So Google, NASDAQ, I've put in the exercise date, I put in the exercise price, and I put in the premium. And so you can see the annualized yield is only 5%. So, I can make 5%, but then I have to set aside the money for just in case if I do get exercise. So I don't think it's a high enough annualized yield. And so I can, I would say let's look at the shorter term to see if the shorter term has a higher yield. Sometimes, the shorter terms do have a higher yield on an annualized basis. And so let's take a look at it. So here is the shorter term annualized yield. So this is the March 17, 2023 cash secured put. So you can see it's only 71 days until the strike. You get around 55 cents for selling it, but it's actually a lower annualized yield. So there is not a lot of confidence in the options market that the stock price will go down to 65 $200 per share, and rightly so. I just don't think that it will happen, but I would love for it to happen. And I think a lot of the people that watch this channel would be buying that security hand over fist if it did happen. And so I think that's why, you know, a lot of people don't think it will happen. But remember, when Alibaba was at $200 per share, a lot of us didn't think that it would go sub $100 per share, and it did happen. So, you know, weird things do happen in the market, especially for people who've lived through, you know, downturns like that we saw in like 2009 or even like in 2001, where things went really sideways. Now I'll leave it there for you guys, but I recently did put out a video on Tesla where I started talking about one of the risks materializing that I talked about recently, which was the fact that, you know, margins are expected to come down, or at least I was hypothesizing that the margins would come down. Well, analysts are now starting to worry about that, and so they started downgrading Tesla as a result of that risk. And if you missed that video, you can get it right here.